If you have a bank account outside the United States, even if it is just a savings account your parents opened for you years ago, you need to pay attention to this 2026 IRS and FBAR issue, because this is not only about taxes. If you are a green card holder or you are applying for U.S. citizenship on Form N-400, unreported foreign accounts can create penalties, and in serious situations, they can create delays, extra questioning, and denial risk if the government believes there was intentional dishonesty. And here is the part most people miss. The rule that triggers an FBAR filing is not about whether you earned interest, and it is not about how much you keep in each account. It is about your combined highest balance across all foreign accounts at any point during the year. In this video, I will break down 3 things by the end. First, the simple rule that tells you whether you likely had an FBAR filing requirement. Second, the difference between FBAR and FATCA Form 8938, because mixing those up is where people get into trouble. And third, a practical checklist to protect your immigration future without panic and without guessing. Now, quick clarity before we go further. FBAR is not an IRS form. It is a FinCEN form called FinCEN Form 114, and it is filed electronically. FATCA Form 8938 is an IRS form that can also apply to foreign financial assets, and it is filed with your tax return if you meet the threshold. They overlap, but they are not the same, and filing one does not automatically mean you filed the other. Here is the key. The U.S. has 2 big reporting tracks. Track 1 is bank account reporting, focused on foreign financial accounts. That is FBAR. Track 2 is foreign financial assets reporting, which can include accounts and other assets depending on your situation. That is where FATCA Form 8938 comes in. People hear a friend say, "I filed my taxes, so I am fine." But filing a tax return does not automatically file an FBAR. That small detail changes everything. So what actually changed for 2026? In most cases, the core rules are not brand new. The urgency is that enforcement and data matching have become more aggressive, and immigrants are increasingly worried about how tax compliance connects to immigration benefits. More people are naturalizing, more people have overseas accounts, and more financial data moves automatically through international reporting systems. That means the chance of a mismatch, or a question, is higher than it used to be. And if you are applying for citizenship, your N-400 includes questions that relate to whether you have met your tax obligations and whether you have been honest with the government. That is why this can become an immigration problem, not just a paperwork problem. Now let us define the rule that creates the most confusion, the $10,000 rule. FBAR is generally required if you are a U.S. person and you had a financial interest in or signature authority over one or more foreign financial accounts, and the aggregate value of all those accounts exceeded $10,000 at any time during the calendar year. Aggregate means combined. At any time means even one day, and exceeded means even 10,001. Here is where people mess up. They think, "I never had more than 10,000 in any single account, so I do not have to file." But the rule is combined across all foreign accounts. Or they think, "It was only briefly above 10,000, so it does not count." But the rule is at any time during the year, based on the maximum value. Or they think, "The money was not mine, it was my parents', so it does not count." But if you are listed on the account, or you can sign and move money, or you have an ownership interest, you may have a reporting duty. This is where people get denied or delayed, because they answer immigration questions casually, but their tax reporting history tells a different story. So who is affected and who is not? Let us put this into clear buckets. Bucket 1. U.S. citizens. If you are a U.S. citizen, you are generally a U.S. person for FBAR purposes, and you may have to file if the threshold is met. Bucket 2. Lawful permanent residents, meaning green card holders. Green card holders are commonly treated as U.S. persons for tax reporting and FBAR purposes in many situations. That is why worldwide income and foreign accounts matter, even if you spend time abroad. Bucket 3. Certain non-immigrants and other residents for tax purposes. Some visa holders can become U.S. tax residents under the substantial presence test and may have reporting duties. This is why students, workers, and families who transition from one status to another can get confused, because the moment you are treated as a U.S. person for tax purposes, the reporting universe changes. Now, who is often not affected? If you are not a U.S. person for tax and FBAR purposes, you may not have an FBAR requirement. Also, if your combined foreign accounts truly never went above $10,000 at any time in the year, you usually do not have an FBAR filing requirement for that year. But do not guess. Use statements, use end-of-month balances, and look for the highest value during the year, not just December 31st. Here is a quick myth versus reality, because misinformation is everywhere. Myth: having a foreign bank account is illegal if you are a green card holder or a citizen. Reality: having a foreign bank account is not illegal. The issue is whether you properly report it when required. Myth: if you did not earn interest, you do not need to report. Reality: FBAR is about account balances and access, not whether you earned income. Myth: if you filed Form 8938, you do not need FBAR. Reality: they are separate, and one does not replace the other. Now let us talk about why this is happening, and why people feel like the government is suddenly catching everything. FATCA created a system where many foreign financial institutions report certain information about U.S. account holders to the U.S. government, often through their local tax authority, depending on the country and agreements in place. That does not mean every account in every country is automatically visible in real time, but it does mean the U.S. receives more data than it used to. On top of that, the IRS has improved matching tools, and yes, data analytics. People describe that as AI, and while the exact internal systems are not publicly detailed in a way you can rely on for planning, the practical reality is simple. The government can compare what was reported by institutions, what you reported on your return, and whether you filed required informational forms. If those do not line up, that is when letters, audits, and penalties become more likely. Here is the part most immigrants miss. Even if your issue starts as a tax reporting mismatch, it can later appear during immigration processes because many immigration benefits involve background checks, review of prior statements, and credibility. USCIS is not the IRS, but if you are asked, have you ever failed to file a required tax return, or have you ever claimed to be a non-resident to avoid taxes when you were really a resident, or have you ever lied to a U.S. government official? Those are immigration questions that can connect back to tax behavior. And if you are in the citizenship process, USCIS looks at good moral character in the statutory period, and sometimes outside it depending on the issue. A pattern of non-compliance plus willfulness can be more serious than a single honest mistake that you corrected. Now we need to be very precise about penalties, because headlines get people scared. FBAR penalties can be significant, and the amounts depend on whether a violation is treated as non-willful or willful, and on the facts. You might hear people throw around numbers like 10,000 plus, or a specific number like 16,536, based on inflation-adjusted penalty figures and real cases people talk about. The important point is not the exact number for your situation, because that requires a case-by-case analysis. The important point is that penalties can be large enough to disrupt families, and even an IRS letter can disrupt your citizenship timing if it creates stress, delays, or the need to amend or correct filings during your N-400 process. So let us break down non-willful versus willful in plain English. Non-willful generally means you did not know you had to file, you did not intend to hide the account, and you did not act with reckless disregard. Willful generally implies you knew, or you strongly suspected, and you decided not to file, or you took steps to conceal. Intent matters a lot. Here is another myth versus reality moment. Myth: if you made a mistake, the government will automatically treat it as willful. Reality: not automatically. Many people correct issues and are treated as non-willful, especially when they are proactive and transparent. But myth number 2, if you wait until you get caught, you can still just file quietly and it will be fine. Reality: waiting can increase risk. Quiet fixes can be risky depending on your situation. That is why you need a careful plan and good advice. Now let us talk about real-world consequences that viewers actually feel. First, money. Penalties, professional fees, and back and forth can be expensive. Second, time. If you are planning to file N-400, you might worry whether to file now or wait until your tax compliance is clean. There is no one-size-fits-all answer, but a mismatch is not something you want sitting unresolved when you are asking the government to approve a benefit. Third, stress and travel. People get nervous about traveling during audits or while fixing past filings. Again, this is fact-specific, but the main point is you want your story to be consistent and documented. Fourth, family dynamics. Many immigrants are on joint accounts with parents overseas, or they have signature authority for a small family business account. You may not think of it as your money, but the reporting rules can still apply. Let me give you an example scenario. This is a composite, hypothetical example to show how a normal person gets stuck. Example scenario. Maria came to the U.S. as an international student, later got work authorization, then a green card. Her parents in another country kept her name on a savings account so they could deposit gift money for future tuition and emergencies. The balance in that one account was usually around $6,000. Maria also had a second account she opened to pay a relative for apartment repairs back home, with about $5,500 at its peak. She never thought about FBAR because neither account was above $10,000. But combined, for a few weeks, the aggregate crossed $11,000. She did not file FBAR for 2 years. Now she is ready to apply for N-400. A friend tells her to just ignore it because it is small. That advice is exactly how people get into bigger problems later. The fix is not panic. The fix is to calculate the actual highest balances, confirm whether she was a U.S. person for those years, and then choose a compliant path to correct it. Here is a second example scenario, because signature authority is a trap. Example scenario. Ahmed is a green card holder. He helps his family business overseas by paying vendors from a company account. He does not own the company, but he has online access and can initiate transfers. He assumes this is not his account, so he does not report it. But signature authority alone can trigger FBAR duties in many cases. Then he files N-400 and answers questions thinking only about his personal accounts. Later, he is asked for clarification. Again, the issue is not that he helped his family. It is whether he complied with reporting rules and whether he is consistent and truthful. Now, what should you do right now, practically, before 2026 deadlines become a crisis? Here is a safe, practical do this or avoid this checklist. Do this. Make a list of every foreign financial account where you are an owner, co-owner, or you have signature authority. That includes checking, savings, investment accounts, and some types of foreign pension or retirement accounts, depending on how they are structured. Do this. Pull statements and identify the highest balance during the year for each account. If statements do not show daily peaks, use the best records you have and be consistent. Do this. Convert to US dollars using a reasonable method for the year and keep your conversion notes. Do this. Check whether you filed FBAR for the years you were required to file and whether Form 8938 applied on your tax return. Do this. If you think you missed filings, talk to a qualified tax professional who has experience with offshore compliance, because the strategy can be different depending on whether the facts suggest non-willful versus willful. Avoid this. Do not assume that filing an amended tax return automatically fixes FBAR. FBAR is filed separately. Avoid this. Do not randomly file late FBARs without a plan if your facts are complicated. Sometimes a rushed fix creates inconsistent statements. Avoid this. Do not move money around suddenly to make it look like the account never existed. That can look like concealment. Avoid this. Do not sign immigration forms that you have not reviewed carefully, especially questions related to taxes, residence, and truthfulness. Here is the part most people want to know. What if you already missed past years? There are compliance pathways that may help people who were non-willful come back into compliance, including streamlined filing compliance procedures in certain situations. The basic idea is to correct past reporting, certify non-willfulness if appropriate, and get compliant going forward. I am keeping this general because the right route depends on your facts, your residency status, and what was filed before. But the practical takeaway is this: there are established processes for fixing mistakes, and many people successfully use them. The worst move is to do nothing because you are scared. Another myth versus reality moment. Myth: if you fix it, USCIS will punish you for admitting you made a mistake. Reality: fixing a mistake is often viewed better than ignoring it, especially when the mistake was not intentional. The risk is not the correction itself. The risk is inconsistency, lack of documentation, or evidence of willful hiding. Now, let us talk about timing and what to watch in 2026. The brief you may be hearing online mentions an April 15, 2026 FBAR deadline. In practice, FBAR due dates and automatic extensions can apply depending on the year, and you should confirm the current due date rules on official FinCEN and IRS resources. The key point is, do not wait until the last minute. Give yourself time to gather statements from overseas banks, which can be slow. Give yourself time to coordinate with a CPA if you need one. And if you are planning to apply for citizenship, give yourself time so your tax filings and your N-400 answers are consistent. Here are 3 watch points that can change your risk. Watch point 1. Increased IRS enforcement campaigns or additional data sharing pressure. Even without a new law, enforcement priorities can shift. Watch point 2. Your life changes, like becoming a green card holder, becoming a tax resident, or naturalizing. Those transitions change what you must report. Watch point 3. Large transfers, property sales abroad, or new foreign investments. Those events can create reporting triggers beyond just FBAR, and they can create questions if the money flow is not documented. So what should you do if you are in one of the high-risk groups? If you are a green card holder with ongoing foreign accounts, focus on annual consistency. Make it a yearly habit. If you are a naturalized citizen who kept old accounts open abroad, do not assume citizenship means it no longer matters. If you are preparing an N-400, do a compliance check before filing. Make sure recent years are filed, any required reporting is done, and you have records ready if asked. And if you are not sure whether you were required to file in a certain year, do not guess based on social media. Use the actual threshold test and your actual balances, or get professional help to do it. Let me recap the most important points in a calm, simple way. 1. Having a foreign account is not illegal, but failing to report when required can create serious penalties. 2. The FBAR trigger is generally the combined value of foreign accounts exceeding $10,000 at any time during the year, not the year-end balance, and not per account. 3. FBAR and FATCA Form 8938 are different, and you may need one, the other, or both. 4. Intent matters. Non-willful mistakes can often be corrected, but waiting and hiding increases risk. 5. If you are applying for citizenship, consistency and honesty matter. Fix problems early so your N-400 process is not disrupted by a preventable issue. If you want, leave a comment with your general category, like green card holder planning N-400, student transitioning to H-1B, or citizen with old accounts, and I can make a follow-up video with the most common scenarios. And if this video helped you, subscribe and turn on notifications, because we cover immigration rules in plain English, without panic, so you can make smart decisions for your family.